this is Abhijit Chatterjee recording our weekly Chartsarefun session for the week of March 24th. Today is March 30th. This has been a very, very volatile week, has been, in fact, for the entire last 6 weeks since the peak of the market on February 19th. There is constant jitters about tariffs, the uncertainty on tariffs. Of course, the resolution should come in next week. The 2nd of April is when the final announcement on tariffs will happen. People would know which countries have been impacted and what kind of tariffs are going to be announced. What shook up the market this past week was the auto tariffs. There was an unexpected, initially the week before, there were some signs that perhaps the auto tariffs would be pushed out, but then a very strong announcement was made, maybe as a last posture to negotiate hard on the various countries on which, in particular Europe, a lot of the European cars come into US. So there was a very sharp pullback in the market after the auto tariffs got announced. In particular, 25% tariffs on most of the cars that are made outside US and some of the auto parts. So we look at the S&P 500. People have been calling for a bear flag. S&P 500, if you remember, had bottomed out on March 13th around 5,500. From there, it tried to mount a 200-point rally, couldn't quite get above the 200-day moving average, failed there, and what in many technical analyst terms formed a bear flag and broke below it on Friday. So we'll look at the chart, we'll see what the bears are calling for. That said, also look at extreme negative sentiment, which to us from a contrarian perspective is a bullish sign. So we are bullish on the market. We'll share what Tom Lee has been saying. He expects a V-shaped rebound. He expects Tesla to be exhibit A of that V-shaped rebound. His expectation is Tesla to climb back up to its previous highs from December around 488. We know that from 488, Tesla had sharply tanked to 217. So we look at the sentiment indicators, the various technical sentiment indicators. We'll also look at the small caps. We believe there is a big put ahead for small caps with Scott Bessent, the Treasury Secretary, making a very strong statement that his intention is to keep long-term yields lower. We know that small caps are extremely interest rate sensitive. So what if the Fed doesn't immediately start making moves for interest rate cuts? If the long-term yields start coming down, it does help the consumers with the loans, both for the housing, the auto sector, and in particular the small caps, because they need to borrow money to fund their growth. So you look at small caps, in particular the small cap ETF, Russell 2000 ETF IWM. We'll look at something that we have made a statement 2 weeks ago. We'd like to reiterate for the perma bulls, called it the gold bugs. Be extremely cautious. We feel a major top is setting up in gold. We'll explain technically why. And we believe a nice contrarian play here is a pair trade. Go long the Bitcoin, short the gold. We think that could pay off quite nicely over the next couple of months. We'll explain through a chart why we think that might be the case. So with that, just pointing you back to our blog site. This is in Substack. We put daily blogs out at about 7 a.m. So if you subscribe to it, it's for free. You'll get an email with the blog as soon as it comes out. You can see here the list of blogs from the archive tab with the various blogs we published in the recent past. Our Chartsarefun YouTube site is at Chartsarefun. We appreciate you subscribing to this channel and also hitting the like button if you like the videos. Our videos, we try to keep it within 20 to 25 minutes. We try to keep our original ideas. You will not see too much of what copying and pasting other stuff, other than we often highlight some of the key parts, like we talked about Larry Williams in the past, we talked about Tom Lee quite often, but the charts and the analysis is all what we have seen from these charts. We call charts are fun because there are tremendous insights in these charts, and our goal is to teach you how to read these charts, how to find these insights, not to sell you anything, not to give you investment advice, because we are not registered investment advisors. Our goal is really to share these fun patterns on the charts. So I did talk about Tom Lee's CNBC interview, and then also he does his fun strat. They have a ETF now that they manage called the Granny Shots. GRNY is the ticker symbol. So he does weekly recordings. This was from last week. He has been highlighting, of course, Tesla, there's vested interest. Tesla is one of his core holdings in the GRNY ETF, but he believes that fundamentally, Tesla has got some strong catalysts in the next several months. He believes that this market is setting up for a very sharp V-shaped recovery post-tariff resolution next week on April 2nd. And he believes that exhibit A of this sharp rebound will be seen in the Tesla stock. As you can see here in the chart that he has shared in his weekly video to his shareholders of Granny, that he expects Tesla, this is a technician kind of giving some of those recommendations that Mark Newton is his technician for FundStrat, that Tesla would rebound up to key resistance around 330, have a bit of a pullback, and then make another run towards 488. We'll share our charts of Tesla and where we think it's headed. We actually feel Tesla is headed to 850. We'll share why. Now, I talked about S&P 500, and I said that the bears in the technical analysis community have been calling this as a breakdown from a bear flag. Why? Because from 61.47, which was the market top on February 19th, we pulled back to 55.04 on March 13th, one of the sharpest and the fastest drop in the market. That's about a 10.5% drop that happened in about 16 to 17 trading days. So 6147 to 5504, we tried to make a rebound. Initially looked like a V-shaped rebound, failed at the just above the 200 moving average shown here in red. At 57.86, we started coming down, and that flag pattern that we can see with the rising trend lines joining the tops and the bottoms of the candles, it broke below. So Friday, we can see a big breakdown, and bears are now looking for this to be a bear flag, and the measured target on that would be from the 61.47 to the 55.04. Just measured the depth of that. That's roughly 643 points. Subtract 643 points from 5504. You're talking about something of the order of 40, something in the order of, so if you take 643 points from 5504, that's right there, 48.61 or something about that level is what the measured target on this breakdown is. Do we think we get back down there? Bears are looking for that. Bears are looking for this breakdown, and that in many ways from a 61.47 to something around that 4,800 would be what, 12 over about 1,300 points, which is 20% drop is what the bears are looking for. We'll look at some of the key indicators. One of the big things in the news was the Michigan consumer sentiment. That has tanked significantly from somewhere around 74, where we were towards the end of the 2024. It has now fallen to 57. This is mimicking a level back to the November of 2022. So we are getting close to that kind of bearish sentiment. And in many ways, this is a contrarian sign because fundamentally, while there are fears, people are talking about the R word, the recession, economy is holding. So yes, there's been kind of signs of fear in the soft data, but the hard data is still holding strong. If employment holds strong, if the retail spending holds up, consumer spending holds up strong, these fears may turn out to be unfounded. Yes, we know that we talk about tariffs and we say there's impact of tariffs to inflation, but inflation has been on a downward trend. And even if we talk about tariffs, it's a one-time increase. Inflation is month over month. Constant increase causes inflation. So yes, even if there is a one-time increase after that, every few months after that, that tariff isn't increasing. It's that same tariff that keeps getting charged. So yes, there is a baseline increase in price, but after that, month over month, that inflation isn't going up. So the fact that many are saying, oh, inflation is going to be on an upward trend is not quite make sense, and is something that the market is just overreacting on. Then that said, the other indicator beyond the Michigan sentiment is something that we measure from an advanced decline line for the New York Stock Exchange. It's NYAD. That one, interesting enough, if you look at the technical chart of that from a 1 hour hourly chart, you can see that the MACD histogram shown in blue is printing higher lows. That's a positive divergence. So as the market is kind of, coming down to retest almost at March 13th low near 5,500. It closed at 5,580 on Friday. We can see that there's higher lows printed on the MACD histogram of that advanced decline line. That means the market breadth. And the same thing with the RSI is also slightly pointed higher in terms of higher lows. That indicates a positive divergence, some indicating that the market breadth on the New York Stock Exchange is actually not deteriorating as the market is coming down. Further, if I look at the summation index, which is also measured from the market breadth for New York Stock Exchange, this is the cumulative summation index. So typically goes between plus 1100 to minus 1100. We last saw that minus 1100 in that bear market bottom around October 2022, minus 1138. Since then, we've tested the 1100 thrice because now we are in that bull cycle. And even in those 1100 thrice, we have now pulled back, and we can see that the real top of that happened in late September at 1112. Market overall, though the Magnificent Seven stocks didn't quite peak out into this year, that's when the call it the bullish exuberance on those Magnificent Seven stocks started waning and they started having sharp pullbacks. Overall market, however, topped towards late September. That's when the summation index topped, and it had dropped quite a bit. But guess what summation index is doing now? If we are setting up for lower lows in the market and S&P is going to go to 4,800, why is the summation index not breaking down to lower lows? Summation index clearly is printing higher lows. 1138 was the extreme level at the October 2022 bottom. In the 23 October bottom, it is minus 834 towards late last year into early this year, minus 435. That was the January bottom. Now, with the S&P breaking down, 10.5% correction, we are only seeing a higher low at 272. And guess what? Last couple of weeks, it has been posting higher. We believe that summation index is going to go back to 1100. We believe we are expecting to see a very sharp rally coming up. This is overdone. We think fundamentally there's no reason for this rally. We feel that this was just a concern with the tariffs, a concern of consumers shaking up while smart money bought, and we expect to see a decent upside coming in the market. Another indication of extreme fear, testing levels of the 2022 bottom in October was the American Association of Individual Investor. The respondents, this is a weekly survey. The percent of bears in that had shot up to 60.9 in the October 2022. Similar level, 60.6 touched towards late February. Since then, we've been climbing lower, but that's just like the market recovered from that October 22 low and started rallying. We expect this to also start printing lower lows as the American Association of Bears start coming down. But that knee jerk did happen late February. Market was extremely bearish. I mean, individual investors got bearish and reflected a similar peak like what we saw. Look at how extreme the MACD on this AAIBear index is. Again, shows extreme fear, shows indications of potential resumption of this bearish sentiment coming down and market coasting higher. Another association of these are the professional managers in AAI, American Institute of Professional Managers. This one also had hit 91 in the February timeframe. This is the exposure of them on the bullish side in terms of buying stocks and so on. That is now reflecting similar kinds of concerns and bearishness as from August. Remember, we had the Japanese stock market crash in early August. The market had pulled back into the July, into the August timeframe. Similar levels is we're not at extremes as the October 2022 at 12, not at the October 2024, 23 at 24. This is also printing higher lows, indicating that professional investors, unlike individual investors, are not panicking. They're not at that lower lows as we saw in around the October 22. They're hanging in there. They're kind of portraying something around the August level of last year, around 56, 57. So that's a contrarian bullish sign. A key sector that has held up the market extremely well is the technology sector. By far now we all know that that's the most bearish sector in this correction, this drop. We can see this kind of waterfall drop from 242. That was a double top that it tested, 242 in January, 242 in February 19th. And we can see the waterfall drop from 242 to 206. Guess what the measured target on the drop was? This is a double top, the M shape of the double top. You're talking about 242 to 224. That's roughly $18. So subtract tracked that $18 from 224, 206. Guess what? It tested that level below 206 at 205.93. Now, from a double top, it's morphing into a beautiful double bottom. This is, again, the technology sector. And if you take the S&P 500, take the 500 stocks and divvy it up into the 11 sectors, take all the technology stocks, and this all falls on the sector spider ETF XLK. So that's the chart we're showing here. It's a daily chart. From a double top, it's nicely traversing to a double bottom. We believe what we saw last week very likely was the double bottom right below 206. This is beautiful positive divergence. The second time it tested below 206, higher low in RSI, higher low in MACD. That's how bottoms form. So we believe a double top is morphing to a double bottom. A classic example of a double bottom is while you have an M-shaped double top, you have a W-shaped double bottom. So for it to confirm the double bottom, you need to take out that W, the mid peak of the W at 218.6, which we expect it to take out in the next few weeks as earnings comes in. We don't expect technology earnings to be that bad. We know that AI spending, CapEx spending is extremely strong. We know that the fundamentals of AI trade is extremely strong, and we'll explain some of the magnificent 7 key stocks that we believe will see big upside in the next several weeks to months. So here we believe this was a double bottom. We expect XLK to break above 218. So from 206 to 218, 12 points, at 12 to 218, 230 is where we think this is going to go back to from this double bottom rebound. Magnificent 7 has an ETF called MAGS, Roundhill Big Tech MAGS. That's also a triple bottom at 45. A key level here we can see was tested from that 45.72 back in August when it had rebounded sharply in a V shape and then pulled back. So that 45 is now becoming, you can see 45 here twice in the late July before it tanked, 45.69, 45.72. That resistance is now support. Price it's tested, beautiful positive divergence again, higher lows in RSI, higher lows in MACD. We believe Magnificent 7 ETF is also bottoming here. We expect it to break above 49 to confirm this bottom and shoot higher. 45 to 49, we're talking about 4 points. Add to 49, 53. That's the level that previously was massive support that it broke down, will now become resistance. So we expect MAGS to make a climb to 53 in the next several weeks. Now I'm talking about some of the key Magnificent 7 stocks. By far, the most bearish sentiment out in the Magnificent stocks is in NVDA. Yet, let's look at the NVDA weekly chart. This is a nice stair-step climb from that low in October 2022 around 10. Look at the beautiful climb. We know that late 22 is when the ChatGPT got announced, the AI trade took off. From the 10, it climbed up to 48, formed a beautiful base. So it climbed in a V shape, tested that range bound level from 40 to 48, then broke on the next big climb from the 30 or 40 level to 140. Then now, guess what's going on? A very similar pattern like we saw in 23, consolidation in a range fashion, in a horizontal range fashion. Similar kind of consolidation going on now from 100 to 150. This 153, by the way, was a double top. The measured target on that was just about close to 100, 101. Didn't quite get there. That's showing strength in the stock. It's holding above in that 104, 105 level. And if it can break out higher, we expect that breakout higher coming in the next couple of months. AI remains a strong trade. Don't forget, this extreme bearishness with the IPO that we just had with CoreWeave is another contrarian sign that market is so bearish that CoreWeave, one of the fundamental partners of NVIDIA, what they do is they buy the NVIDIA GPUs, they then rent them out. People are not got the capacity from kind of buying these GPUs. So what they do is they, for AI workloads, they go rent it out from a data center like CoreWeave. So CoreWeave's fundamentals are weak, of course, because of a lot of debt on their balance sheet. But if the AI trade remains strong, they continue to sell space on their AI out to the customers who can't afford to expand their data center spaces. CoreWeave could do well. And NVIDIA's fundamentals, remember, Blackwell has got ramping up of sales this year. From Blackwell, they'll get the next generation chip coming out. This is a company firing on all cylinders. I mean, Jensen has been indicating with all bullishness that you're seeing now, from the agentic AI to the physical AI, that's when the Optimus robots, that's when the autonomous driving will take off. Physical AI is the next big thing into next several years. AI trades got legs, and this is beautiful consolidation. Couldn't say anymore that for those looking to play the AI game, NVDA is the king, expect it to break above. I don't expect it to break below this horizontal range. This is the classic consolidation like we saw. No one wants to talk about NVIDIA. No one wants to buy it. You always do the opposite of what people say. So the contrarian trade here is go long NVIDIA, expected to break 152 and climb a lot higher above 200. That's where we expect the NVIDIA trade. A clear measure trade from 90 to 150 is 60 points. Add 60 to 150 is 210 right there. That's just the bare minimum move that we expect on the next bull run for NVIDIA to climb. That said, another AI player is Google. It's a beautiful buying point. Why do you think it's at a buying point? Look at the excellent cup and handle pattern on its weekly chart. From 152 to 183 back to 154. 83 to 154 is 71 points. Add 71 to 154. That's 225. Did it meet that target? Not quite. It met a high near 208 towards late January. Then the earnings came in February, tanked significantly. Well, where did it tank to? A beautiful rising channel. If you join the tops, join the bottoms, it just tested the bottom of the rising channel. We expect a strong rebound here. Guess what it's testing? It's testing at 155, 154, which was key cup and handle resistance, which is now strong support. Worst case, yes, it could retest that 147.8, 148. If you get there, it's a screaming buy. You're lucky if you can get the 148. I have a feeling that very soon Google is going to rebound and expect it to go back towards that measured target on this cup and handle towards the 225. So from somewhere around the low 150s to a 225, you're talking about a 50% move. So 156, say the low 150s to 225, you're talking about 70 to $75 out of a 155. That's almost a 50% climb. That's a beautiful upside in Google. Tesla, I'm going to talk about something that we believe is carving out a long-term cup and handle, which has significant upside. Why? 414 was its peak back in 2021, from where it sold off to 101. Remember, this was the bearish low in early 2023. This is when there was significant fear of Tesla not being able to win back their China share. All the EVs in China were taking over their market share, and stock in turmoil. Well, it climbed back. It climbed back huge to 488. And then this pullback, the handle that we got was extreme negative sentiments about Elon Musk, his involvement with President Trump's administration, running Doge, and spending less time in the company Tesla to manage its fundamentals. That said, we know that a major tariff announcement of 25% tariffs on foreign-made cars directly helps Tesla. Tesla's cars sold in US are mostly sold and created in US. So they don't expect to have to suffer from tariffs. Yes, they have cars made in China, but those are sold mostly in China or Europe, not impacting their sales in US whatsoever. If any, they can start fighting competition from General Motors, Ford, and others, not just in the EV space, but win over some of the ICE, the internal combustion cars, into EV buyers because of the pricing. If you expect 25% higher price, which is in thousands of dollars additional price to the internal combustion engine cars manufactured outside US and sold in US, that's what a lot of the General Motors, Ford cars and the Stellantis cars are. They're mostly made outside US. That's going to effectively benefit Tesla. So this could have fundamental reasons for it to break higher. And above all, they are the key tech stock. They are an AI player with their Optimus robots going into production into their factories, helping reduce the price of the car down from 30,000. They expect to bring it down to 25,000 or lower for the entry-level car of the Teslas. They expect to have the next generation of Model 3 and Model Y, and they're going to go autonomous driving. They plan to launch it in Austin later this year. That would bring in opportunities to kind of compete with, take every car and without a driver behind it, have it out there for car hailing service, compete with Uber and Lyft, and by far kind of bring in high margin business to their AI space. Then, of course, Elon Musk has been extremely bullish about the robots, Optimus robots, saying that these are the humanoid robots, human-shaped robots that can do a lot of repeated tasks and could at some point have, just from his projections, 10 trillion of sales is what he expects the humanoid robots to generate in the next several years. So this breakout, if that does pan out, this cup and handle measures to 101 to 488. That's a $387 depth of the cup. So take the 387, add it to the 488, you get an 875. So 875, there have been one or two bullish analysts out there that are projecting an 850 and higher target. And Dan Ives is perhaps one of them. Maybe the Morgan Stanley analyst as well, but either of them, are being extremely bullish on Tesla. But the chart, in my opinion, looks very bullish. And if this cup and handle does pan out, extreme bearishness, look at the last two candles. This is a weekly chart. Last couple of weeks, beautiful doji reversal. These are nice long tails that are bullish tails, bullish reversal tails. We saw a similar kind of bullish reversal tails, guess what, right here at the 101 bottom. See how it kind of formed the long tails and close towards the highs of that range of that week. Two bullish reversal tails here, similar to bullish reversal tails here. We could get an opportunity to buy Tesla on a pullback into early next week where it closes out that gap. But from there, we expect it to start climbing, expect it to break 488 and make a climb to 875. So a way to play it is there is a double X Tesla called TSLL. It's an ETF. So if it moves, Tesla moves 10% and moves 20%. So TSLL is one way for those who are bullish on it. But otherwise, even if you're kind of bearish, you might get reasonably good premium. You might just sell a put at 217, like 210 or $200 and just collect the premium. It's unlikely that Tesla will break 217. It's kind of set its bottom. If you sell a premium there into even next couple of months or into summer of this year or next year, you're going to be able to collect the premium and keep that premium. So selling a put is one option, or if you want to just buy calls on Tesla or just buy the stock outright, we expect a very nice cup and handle bullish resolution on that. I'm going to talk about small caps. I did say that we believe that small caps will be huge beneficiary of Scott Bessent's Treasury put. He's going to bring the long-term yields lower. That's going to directly help small caps, interest rate sensitive. Guess what that's forming? This is a beautiful rising channel on the weekly chart. If you join the highs, join the bottoms, a rising channel, guess where it's pulled back to? Exactly at the bottom trend line of the rising channel. Is looking like a beautiful bullish reversal candle right here with a long tail. And now it's got a pullback. We expect in the mid 195, an excellent buying point. We expect it to start rebounding and moving a lot higher. This is the weekly chart. We believe it's a beautiful channel that it's going to continue climbing higher. If you look at the longer term monthly chart, all the way from the 2009 bottom, we can take those extreme lows in 2009 and then in the COVID bottom, and then the tops. We can see that it's right now not at the bottom of the channel. It's at the midpoint of the channel. We expect it to climb higher. And when it climbs higher, we expect it to hit over 300. So where do we see that target? Well, this is a beautiful cup and handle. 233 to 157 was the 2022 bottom, back to 243. Break that to 43, we expect it to go to $330. That's the cup and handle. We believe the beautiful handle is forming. We believe that if America is to be made great again, guess what the small caps are going to do? They're going to start powering higher. They're going to start doing extremely well fundamentally. So if America is to be made great again, it will be through the small caps, and we believe the small caps are poised for huge upside. These are the times to buy when no one wants to touch them. Look at the beautiful, strong secular bull market run that the small caps have been having. It's been climbing, hugging the 50-month moving average shown here in blue. It keeps rebounding off that. We're right at that level again, testing that 50-month. 196.3 is the 50-month moving average. We tested 196.5. Beautiful place to go long on small caps because we believe this upside is huge to play in the next several months to couple of years. So extremely nice buying point on the small caps, and we believe that this is kind of a beautiful entry for small caps. You can see again, double test of 157, 158 happening in 22, 23. That was it. And then a nice, beautiful base here from 157 to 195. We've broken above that. And since we've broken above that, guess where it holds a strong support? That resistance level at the top of that base at 195 is now strong support. We expect this to hold, not to break, and then to start climbing higher towards that 330. So again, very, very bullish on small caps. What we are not bullish on is gold. While the world is hugely bullish on gold, we have a contrarian view on gold that we think that gold is setting up as a major top. Take the daily chart. We can see that 2790 to 3000 is closer to the 3100 level. Guess where the RSI is? At a lower high. That's how tops form. Negative divergence. Higher price in gold, lower levels in RSI, negative divergence. Same with MACD. Lower lows in MACD as we go higher prices. Guess a look longer view. This is a beautiful cup and handle on gold that it's almost completed. From 1920 was the 2011 high, had come down to 1045 around 2015. From 2015 to 2020, it climbed to 2074. So 1045 to 2074, you're talking about roughly 1,029 points roughly. So 1,029 points add to the 2,074, that's 3,104. That's the top. Where are we at? We are at 3,086. 3,086 to 3,104 is not too far. You're talking about less than 20 points to gold topping out. Look at how extremely overbought the RSI is at 82. Look at how extremely overbought the MACD is, stretched up at a higher high, but at levels not seen till way back towards the early 2011. So this is the cup and handle. The measured target is 3,104. It's within 20 points of that. Take a longer term view. This is a yearly chart. Every candle is 1 year. Guess where the biggest rises of gold happened? They came during secular bear markets. In the 70s, we had the secular bear market, and then from 2000 to 2011, 12 is when the next secular bear market happened. In both those periods, if we count the number of rising candles from the bottom end of the rising wedge, and by the way, this is from the technical term called a bearish rising wedge. When you have the tops and the bottoms converging, you have the tops kind of climbing and the bottoms climbing, and then they come to an apex converging. That's called a bearish rising wedge. That same bearish rising wedge is similar on the yearly, very long-term chart going back to 1969. So from 1970 at the bottom of that bearish rising wedge, it climbed to the top in 11 years. Each candle is a year. This is a yearly chart. 11 years it topped out. Then it pulled back to the bottom end of the ascending channel. Then from there it climbed again. Again, count the number of candles here from 253 to 1920, 11 candles. Guess what the recent climb is? From 1045 to 3100 is our target. Just count the number of candles, 11 candles. So the periodicity wise, that 11 yearly climb is getting to its peak. Look at the RSI, not getting any stronger. It's a lower high in RSI than what we saw in the previous peak at 1920. So we believe, and look at how overbought it is from the full stochastics indicator at 94, RSI at 85 at the yearly chart. That shows overboughtness not from daily, weekly, monthly, from the longer term yearly chart. And in our opinion, this is a beautiful cup and handle that I already talked about. Its target 3,100 is being met. So what we see is that contrarian play is to look at Bitcoin instead. Bitcoin, if you take a ratio of Bitcoin to gold, that had been at the 37 level, pulled back to below 9 to 8.78, back to 34, broke out higher, and guess what? It's forming a rising channel. It's where it's at right now at the bottom of that rising channel. We expect a strong rebound here on the ratio. What does it mean? If the ratio rebounds, that means it's Bitcoin on the numerator, gold on the denominator. We expect Bitcoin to rise while gold come down. That will cause this ratio to break out. Usually you don't do technical measurements on ratio charts, but if I measure it from 8 to 34, you're talking about 26, add 26 to 34. That's how much? 60. So the ratio has to become 60 of Bitcoin to gold. Say gold pulls back from right now, it's here 3,100, say to 2,500. So very good chance that I believe gold could pull back to 2,500 in the next few months. So when gold pulls back to 2,500, multiply a factor of 60 on this ratio, that gets us 150,000 target on Bitcoin. If you remember in my previous videos, I've talked about Bitcoin's target anywhere from 135 to 145, around that 150 or 100 up levels where we think Bitcoin can climb. And that's beautifully gelling up with where we think this pattern of ratio analysis is telling us. So in sum it up, our views are don't get scared about the S&P's bear flag. That's a contrarian sign. Be bullish on this. This is not going to break down from 55 all the way to 48. If it does, that would be a screaming buy. Unlikely that we're going to break down there. Next, all these bearish sentiment indicators are giving indication that this is contrarian time to buy, not to panic and sell. So don't panic. In particular, look at this beautiful New York Stock Exchange Summation Index, higher lows. That's indicating market breadth improving, not deteriorating as we've S&P selling back. So this is a beautiful indicator. There's a very good chance we make another climb towards the max overbought. When it gets to 1100, I would then say, yes, be cautious about the market, start lightening up, start taking some profits. But till then, this is market breadth only kind of gearing up to further improve and get to that level when the market gets to the next cyclical top. So that XLK, the technology from a double top is morphing to a double bottom. If technology has to rally, it would mean Magnificent Sevens will rally. It's also forming a beautiful bottom of the MAG-S ETF near 45, below 46, 45.6, 45.7. We expect this to rebound. Beautiful positive divergence there. NVDA, we believe, will break out of its range pattern to a higher high above 153, break 200 and go towards 210. Google, we believe, is going to be a nice rally from the low 150s to the 225 is where we think Google is headed. Tesla, we think, has one of the best upsides in the Magnificent Seven. This beautiful long-term cup and handle breakout could take it above 488 to 875. So that's literally almost a quadruple from the low 20s to low 200s to the 875, a quadruple of Tesla. The IWM, the small caps, we think will be beneficiary. We think that this rising channel is nicely going to hold the support. We believe that small caps are setting up for a nice rebound to the top end of this channel, and most importantly, from this cup and handle from 157 to 243, add that up to the top rim of the cup to 330. That's where we think the small caps are going to rally. Extremely valuable point to buy the small caps. Be very cautious on gold. This long term, the near term daily chart is showing a bearish rising wedge. Same thing with the longer term. It has met its cup and handle pattern at 3,100, almost within $20 of that pattern. On the very long term yearly chart, very bearish wedge forming, negative divergence in RSI, extremely overbought stochastics, indicating that gold pulls back. Good chance you can see that this pullback will come all the way down towards its 50, from the 50 daily moving average towards the 200, 2640 is where we think it could pull back to. We can see the 2500 in the past, 2530, that will now become strong support. So we believe a pullback from the 3100 to 25, you're talking about 600-point pullback in gold is likely, about 20% pullback. While that pulls back, guess what's going to benefit? The Bitcoin is going to see money moving in. You see a nice risk on trade panning out, the ratio climbing from near 25 towards that 60 level. From a 2500 to a 60 gives us about 150,000 Bitcoin price. That's where we think Bitcoin is headed. Good luck investing. We'll talk to you next week.